Welcome to this explainer. Look, today we're building something that's going to completely change how you look at the markets. A stress-free, high-probability swing trading system. The goal here? To get you to stop staring at your charts all day. If you've ever felt totally overwhelmed by those flashing red and green lights, trust me, you are exactly where you need to be.
I know, it sounds totally counterintuitive, right? But what if you could actually make more money by staring at your charts less? Seriously. In this explainer, we're going to figure out how to ditch the anxiety, the crazy losses, and that sheer exhaustion of day trading. We're replacing all of that with a rock-solid systematic checklist that practically forces discipline. It's time to step away from emotional reactions and step into cold, objective execution.
So, here's our 6-part flight plan for today. We'll look at the swing trading advantage, determine trend direction, map institutional zones, apply the 50% discount rule, wait for entry confirmation, and wrap it all up with our final trade checklist. Let's jump right in.
Section 1, the swing trading advantage, reclaiming your time. Okay, let's start with exactly why we're using a swing trading framework instead of frantic day trading.
Just look at the clear contrast here. On the left, you've got your classic amateur day trader. They're stressed out, over-trading, waking up at the crack of dawn, and honestly, they're incredibly vulnerable to the minute-by-minute market manipulation pushed by big institutions. But on the right, that's our goal, the checklist swing trader. This kind of trader checks their daily charts, maybe even right in the middle of the day, plots their levels, and just patiently lets their edge play out over days, sometimes weeks. It's really all about reclaiming your time and just tuning out that intraday noise.
Section 2. Determine trend direction, the macro map. Your absolute first checkpoint in this system is nailing down the overall trend direction. You need this macro map before you even think about entering a trade.
We tackle this by zooming in from the top down. You always start with the weekly chart to grasp the big picture. Like, who's actually in control right now, the buyers or the sellers? From there, you step down to the daily chart to map out those major swing zones. Next up, the 4-hour chart. That's your setup confirmation. And finally, if you really need it, the 1-hour chart acts as your ultimate precision instrument for the actual entry.
This shows exactly what you're looking for on those higher time frames. You absolutely have to identify the market structure. Are we making higher highs and higher lows? Well, that's an uptrend, which means you are only looking for buying opportunities, period. Or are we making lower highs and lower lows? That's your classic downtrend. Now I know it sounds super basic, but failing to accurately map this structure, that is exactly where most traders end up losing their shirts.
So keep this rule burned into your brain. Never trade against higher time frame momentum. Seriously, a massive pitfall for amateurs is trying to go long on a 1-hour chart when the daily chart is just in a crushing downtrend. Always make sure your lower time frame setups align perfectly with your higher time frame bias. If they don't match up, you just walk away. You don't trade.
Section 3. Map institutional zones, following the big money. All right, once we know the trend, we have to map out where the smart money is actually hanging out. We do that by reading volume and previous price action.
To track down that smart money, we use a tool called the volume profile. Now, standard volume bars down at the bottom of your chart, they're totally incomplete. They only tell you when a lot of trading happened, like say at 9:30 a.m. But the volume profile, it's rotated 90 degrees right onto the price axis. It tells us exactly at what prices the most volume was transacted. This is an absolute game changer because it shows us right where institutions are building their huge positions or exactly where trapped traders are sitting.
When you actually throw the volume profile on your chart, you're going to see 2 very distinct zones. First, high volume nodes. These represent areas of heavy trading and fair value. Price action here gets kind of sticky. The market just loves to consolidate here because buyers and sellers are basically agreeing. On the flip side, we have low volume nodes, which mean thin volume and unfair value. Because nobody's positioned there to slow the market down, price will just rapidly rip through these low volume nodes like they're thin air. So you want to be trading around those sticky, high volume magnets.
Now, alongside volume, you've got to make it a habit to always look left on your chart. Look left to find where buyers previously stepped in with serious force. That's your demand. Look left to find where sellers violently rejected the price. That's your supply. Map out those previous swing highs and swing lows. But hey, keep this in mind. These institutional areas are broad, dynamic zones. They are not perfectly exact, drawn to the penny lines. And the more times price is rejected off a certain zone, the stronger that level becomes.
While you're mapping out these zones, you really need to watch out for the trap of the invisible wall. If you see massive volume bars, but the candlestick itself is tiny and barely moving, that's absorption. Smart money is quietly sitting there absorbing all the retail buy orders before sharply dropping the price in the other direction. Always look for effort that actually matches the result. That's how you avoid getting trapped by the big money.
Moving on to Section 4. Apply the 50% discount rule, stop overpaying. This next checkpoint is absolutely crucial. It ensures you aren't overpaying for an entry when an asset is already way too extended.
You see, novice traders constantly fall into this trap, buying immediately at the absolute peak of an impulsive move just because of FOMO, the fear of missing out. You see 3 giant green candles, you panic, and you smash the buy button, only to watch the market inevitably pull back 5 minutes later. It stops you out right before it continues the trend without you. Come on, we've all been there, right?
So to fix this once and for all, we bring in the magic number 50%. We treat this 50% line as our absolute non-negotiable discount shopping barrier.
Here's how we actually build this into the strategy. Grab your Fibonacci retracement tool and draw it deliberately from the most recent swing low right up to the swing high. This slices the move right in half. The top half, from 0 to 49%, that's overpriced territory. Do not shop there. The bottom half, from 50 to 100%, is your discount zone. By measuring the impulsive move like this, we strictly forbid ourselves from entering any long trade unless the price pulls back completely into this discounted area. It is such a simple rule, but it will literally save you thousands of dollars. Section 5. Wait for entry confirmation, the final trigger. Now this step, it's all about patience. Just because the price dropped into our discount zone and hit our mapped level doesn't mean we just blindly buy. We need actual proof.
What we want to see is a clear, exhausted pullback. Ideally, that looks like 3 consecutive red candles dropping right into our mapped demand zone. From there, you look for undeniable proof. Watch for a retest of a moving average, maybe the 8-day exponential moving average to catch momentum, or the 200-day simple moving average for macro support. You really want to spot a strong volume spike right at the edge of our zone. That proves the institutions are stepping back in. This creates that classic break-and-retest setup that gives you the highest probability of winning. But wait, here is the single most critical rule to avoid catching a falling knife. The confirmation candle must fully close before you pull the trigger. If you just see a quick green flash and jump in before the hour or the day is actually over, you're front-running the trade. Don't do it. Wait for the candle to close. That proves the buyers actually held the line.
All right, Section 6, Final Trade Checklist, Clearing for Takeoff. We've got all the pieces of the puzzle now. Let's synthesize them into a strict, totally emotionless trading system.
This is it, your ultimate pre-flight checklist. 1. Is the top-down trend direction verified? 2. Is the price returning to a mapped, high-volume institutional zone? 3. Is the pullback within that 50% Fibonacci discount area? And 4. Has a bullish confirmation candle fully closed with strong volume? I want you to treat this checklist exactly like an airline pilot does. If even a single box is unchecked, the plane stays on the runway. You do not execute the trade.
It really is just that black and white. If you skip a step on this checklist, you aren't trading anymore, you're gambling. This highly structured process is designed entirely to strip away your emotional bias. It literally forces you to wait for only the highest quality setups, protecting your hard-earned capital from institutional traps and, honestly, from your own impatience. Well, we've covered a ton of ground today, from market structure and volume profiles to Fibonacci discounts and super strict entry triggers. Your checklist is now fully ready to go. So, the big question is, will your very next trade pass the test? Start applying these exact steps to your charts today, draw those zones, wait for the discount, and discover how an objective, checklist-driven approach can completely transform your profitability. Thanks for diving into this explainer with me today, and hey, keep those charts clean.